I'm a massive advocate of the people who take the leap and choose to build their own business. Now, having run a business myself for the last few years, I do understand the risks and the struggles that come with giving up a regular paycheck and choosing to build something for yourself. But one thing I have found over the years is that self-employed people typically tend to be pretty bad at building their personal net wealth. That is, assets outside of the business. They often channel all their time, effort, and attention into building that business. And this means that other things get neglected, like building your personal net wealth, assets outside of the business. And this leaves them in a very risky situation financially. So today I wanted to make this video for all the self-employed people out there and give you a few of my top tips as to how you can build a financial plan, an effective financial plan, as a self-employed person. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we're talking about building a financial plan as a self-employed person. Now, let me just preface this by saying that this video already assumes that you have an existing business that's generating revenue. So it's not a guide as to how to set up, structure, or run a business. I'm assuming that you're doing all those things fine. This really is a guide as to how you can build a financial plan to grow your personal net wealth. Firstly, a financial plan is forward-looking. It's basically instructions as to where your future income is going to be allocated in order to achieve your financial goals. So the first thing that you need to do as a self-employed person is to create a steady, reliable income source from your business. Sometimes this can be a lot easier said than done because I know that for a lot of businesses out there, income streams can be lumpy. Some months you might kill it and you might have lots coming in. Other months you might have nothing. Now that's the nature of running certain businesses, but this shouldn't stop you from creating a regular, sustainable income stream from your business. In order to do this, I suggest you establish a healthy cash reserve. Now this isn't like the emergency fund that most people have in their personal situations. You should probably have one of those as well, but this is a cash reserve within your business. And I always recommend people aim for 3 to 6 months of income, that's the income you're gonna draw from your business, plus expenses in that cash reserve. Now, if you run a business that has a fairly reliable source of revenue, then you can probably go for 3 months. But if your business really is sporadic with when the income's coming in, then you should probably aim closer to 6 months. What this is gonna do is it's gonna allow you to take a regular income stream from your business no matter what you've done for the month. So in really good months, you're gonna be topping up that cash reserve, and in bad months, you're gonna be drawing down from it. And it doesn't matter how you take the income from your business, whether it's drawings or salary, the same principle applies. Make sure you always have that buffer there so you can draw down consistently. By doing this, you've just achieved a crucial element in a financial plan, and that is to create a reliable income source. You can now take the plan to the next step and allocate that income source to where it needs to go in order to achieve your financial objectives. Next, you need to start using a portion of that income to start building assets outside of your business. Now, what this is gonna do is it's gonna de-risk your situation because for a lot of people, they have all of their income tied to their business and their assets tied to their business, and that's very risky. By building assets outside of the business, you have something to fall back on if the business were to fail or go through a hard time. By creating those assets outside of the business, you're gonna be diversifying both your income sources and your asset base. Now, this is an important step and a necessary step in order to achieve that sense of financial freedom that people seldom achieve. Now, there are many different avenues that you can use to build wealth, but typically speaking, for a lot of people, it's often a good idea to start with buying your own house, building a bit of equity in that house, and then look to diversify in other more exciting things like shares or maybe another investment property or something like that. But one thing I would also add is that it's very important you allocate some of that money to superannuation. Superannuation really is a fantastic system that lets us invest for the long term and get a tax benefit for doing so. But a lot of self-employed people tend to ignore their superannuation because they don't have to make payments into their super. But today I want to tell you clear as day that if you earn over $20,000 a year and you're not utilizing your superannuation, then you are not maximizing your wealth. You should, at a minimum, be putting in 10% of the income that you draw down from your business as a tax-deductible contribution into your superannuation. Now, obviously, there are cap limits and things like that you need to be aware of, and I'm not going to touch on those in detail now, but typically in the current financial year, you can put in $27,500 into your superannuation and get a tax deduction for it. And if you want to know why I like superannuation so much, I've done plenty of videos on it in the past, so go back and watch one of those. I'll link one in the description box below. Next, I want to talk a little bit about borrowing money as a self-employed person. Now, the ability to leverage opens up a whole new world of wealth creation strategies, but for a self-employed person, it can be more difficult to borrow. Most lenders want to see 2 years of tax returns, and generally they'll take an average of those 2 years to work out the amount of income that you can use to service a loan. So that means as a newly self-employed person, you probably shouldn't be trying to borrow money for at least 2 years, at least not for a big property purchase or something like that. The other issue I find with self-employed people and borrowing money is that they do everything they can to minimize the profit in their business to pay less tax. And now, while paying less tax is great, it does mean that you're going to be able to borrow less money because the lender will want to see your financials in order to determine how much money you can borrow. So if you're one of those self-employed people out there that get a little bit colorful with what you claim, so maybe you put some living expenses through your business or something like that, then not only are you going to have the ATO breathing down your neck, but you're also not going to be able to borrow as much money. And it's the same as if you do cashies. Now, I know a lot of tradies out there love cashies, and again, the ATO doesn't like this and you shouldn't be doing it. But if you do cashies, you're not going to be able to borrow on that money because you don't have any proof of your income. So the moral of the story is you need to pay some tax in order to borrow money. Now, we've talked a little bit about building an income stream, creating some assets, using your superannuation, borrowing money. But what about protecting your financial position as a self-employed person? There are different layers of protection that you need to have. There's the protection that comes from structuring your business properly. So maybe instead of being a sole trader, you operate through a company. There's protection that comes from the industry-specific insurances like professional indemnity or public liability insurance. But today I want to talk about protecting your financial position in the event that you weren't able to work due to accident, illness, or injury. Self-employed people typically need to consider the same personal insurances that any other person would. So that's life, TPD, trauma, and income protection. But on top of that, you also need to consider what would happen to your business if you weren't able to work in it. So that's where additional layers of insurance like key man cover, business overheads, and buy-sell agreements come into play. As the name suggests, key person insurance is going to protect the business in the event that you lose a key person temporarily or permanently. Now, this comes in the form of a life TPD or trauma policy held over the key person with the benefit payable to the business. And that benefit can be used to either replace revenue or use as working capital. Now, just be aware there are different tax treatments of that insurance depending on whether it's used for revenue or capital purposes. I'm not going to go into that in detail now. Business overheads is another form of insurance that may be appropriate, and this is a little bit like an income protection policy for your business. So if you're unable to work in your business, a business overheads policy is going to pay your ongoing expenses for up to 12 months. And if you have more than one owner in the business, you should have a rock solid buy-sell agreement in place. That means if one of the owners weren't able to work in the business because they passed away or maybe they're permanently disabled, it's going to allow the other owner to buy out their share of the business. And it often uses a death or TPD policy as a source of funding in order to do that. So as you can tell, There's a lot to consider when putting together a financial plan for a self-employed person, and this is by no means an exhaustive list. But it's important for you to sit down and consider what's appropriate for you and your situation. But that's it for me today, guys. Thanks a lot for watching. If you like the video, please give it a thumbs up, and I will see you guys in the next one.